Hi and welcome to demonstration video for brief exercise 12-1, exercise 12-1, and problem 1-1. What I'll do is I have three different tabs down here. This tab will be for brief exercise 12-1. This will be for exercise 12-1, and this tab will be for problem 12-1. So I will post this in the video as well in the notes. So you'll get a chance to print it out if you need to help you along with the assigned homework or practice homework. However you want to utilize it, it's really up to you. Okay, you'll need your book, and the first one we'll be doing is the brief exercise 12-1, and this is on page 703. And I will start out by doing this first problem, and then I'll move to the next tab and so on. Okay, so for brief exercise 12-1, Lance Brothers Enterprises acquired 720,000 of 3% bonds dated July 1st on July 1st, 2013 as a long-term investment. Management has the positive intent and ability to hold the bonds until maturity. The market interest rate yield was 4% for bonds of similar risk and maturity. Lance Brothers paid $600,000 for the investment in bonds and will receive interest semi-annually on June 30th and December 31st. Prepare the journal entries A to record the Lance Brothers investments in the bonds on July 1st, 2013, and B to record interest on December 31st, 2013 at the effective market rate. Okay, so in requirement A then, we're going to journalize the bond to record the bond or the investment at July 31st, 2013. July 1st, excuse me. Oh boy, let's do it again. July 1st. Okay. All right. So we have, because Lance Brothers Enterprises acquired the bond, we have to put it into our balance sheet as investment in bonds. That will be the account name. That will be my debit of $720,000. Okay. This name here doesn't have to be investment in bonds. It could just be investments, or it could be just bonds. There's different names, but we're just using this name for now. There could be different names among different companies. Okay, and we also paid the company paid cash, and they paid cash in the amount of $600,000. So that difference from that $720,000 to the $600,000, okay, I'm just gonna pull formula in here, is $120,000, which will be our discount on bond investment, which is the difference. Okay, so that's how it would look like, our journal entry. We will have a credit to cash of $600,000 because they used cash to purchase these bonds, and they will then record in their balance sheet for investment in bonds of $700,000, and they will have a discount on bond investment of $120,000. And discount on bonds it's a contra asset account. It's going to go ahead and decrease this investment in bonds or net amount. At the end of when the bonds mature, the amount of the discount netted with the $720,000, excuse me, that the discount on the bonds investment, well, when it netted with the bonds, will equal that cash price. Okay, and B, the requirement in B is to record the interest on December 31st, 2013 at the effective rate or market rate. Okay. So at this time is when Lance Brothers Enterprises receive cash in for the interest. So we know we will debit cash. We know we will debit discount on bonds investment. And we will record interest revenue. Okay. So first of all, with the cash amount, excuse me, hold on here. Okay, so interest, I'll do the interest first. It's 2% times 600,000. The bond yield of 4%, but because interest is calculated twice a year, you're going to take 4% divided by 2, which is 2%. So I'm going to do that. So our interest is going to be 12,000. And then our cash is going to be the 720,000 times 1.5%. So that'll get us to did I put too much in there? There, that looks better. Okay. I forgot to put the percentage in there, that's why. Okay, so our difference, which is the discount on bond investment, is going to be $1,200. Okay, so before moving on to exercise 12-1, oops, yep, that's what I forgot here. Okay, so this is 1.5% times 720,000. Remember the bonds yield a 3% interest, and because once again, interest is calculated semi-annually, you're going to take that 3% divided by 2 because interest is calculated twice a year. We're going to get 1.5%, and that's how we got that $10,800. So that's how we record the interest for the bonds at December 31st, 2013 using the effective market rate. So that's brief exercise 12-1. All right, so let's move on to 12-1, exercise 12-1. I'm going to do it on this new tab. So you just click on the bottom here, and let me just denote that this is exercise 12-1, and this will be on page 705. All right, so first of all, once again, you'll need your book. I will read through the problem, and then we will I'll go through and show you how to do each requirement. Tanner UNF Corporation acquired as a long-term investment $240 million of 6% bonds dated July 1st on July 1st, 2013. Company management has the positive intent and ability to hold the bonds until maturity. The market interest rate yield was 8% for bonds of similar risk and maturity. Tanner UNF paid $200 million for the bonds. The company will receive interest semi-annually on June 30th and December 31st. As a result of changing market conditions, the fair value of the bonds at December 31st, 2013 was $210 million. Okay, so for requirement 1, we are to prepare the journal entry to record Tanner UNF's investment in the bonds on July 1st, 2013. Okay, so for requirement 1, once again, kind of like the same brief exercise here that we did here, our journal entry is going to look very similar. We are going to debit investment in bonds, which is the face amount, and the amount of 240 million. Okay, these are going to be pretty big numbers. So I'm going to do this and do that. Okay. I'm not sure what Connect is going to have you do. It might have you put in the full amount, or it might have you put in just 240 and stating that it's in millions. So I'm going to do this for now. I'm not sure how Connect is going to make you do it, but if you have confusion with it, just let me know. Okay. And then our credit amount is going to be discount on bond investment, and the cash, the price that we paid for the bonds. All right. So we pay cash in the amount of 200 million. So our difference, which is the discount, will be then 40 million. So that's requirement 1. And requirement 2, prepare the journal entry to Tanner UNF to record interest on December 31st, 2013, and the effective market rate. Okay, so very similar once again to brief exercise 12-1, what we did here. So we know we're going to be debiting cash, and the bonds yield is 6%, but once again, because we are calculating interest semi-annually, that 6% divided by 2 is going to be 3% times the 240 million. My debit also is going to be discount on bond investment. And my interest is going to be the credit because we are recording interest revenue here. And once again, the interest yield is 8%, but we are calculating interest semi-annually, so it's going to be 4% times the 200 million. Okay, so here's my calculation. 200 million times 4%. And then 240 million times the 3%. And my difference then is going to be my discount on bond investment of 800,000. Okay, so basically we got cash in of 7.2 million for the interest because we bought it at a discount. That 800,000 is going to go towards discount, and we record for interest revenue $8 million. Okay. Requirement 3. At what amount will Tanner UNF report its investment in the December 31st, 2013 balance sheet, and why? Okay. I'm going to be typing what I'm writing down so that you can see what I'm saying so that you can use it for later on. All right, so Tanner is going to so Tanner's going to report its investment in the December 31st, 2013 balance sheet at its amortized cost. And this will be the book value. Okay. So this is how it's going to look like in the balance sheet. You're going to have investment in bonds, which is going to be listed in the balance sheet. Investment in bonds is going to be at 240 million. Okay, because that's what they bought it for. That's the cost amount. Where you're going to subtract the discount on bond investment, which is going to be our 40 million, minus the 800,000 from up here, okay? So that's going to equal, let's do this here. Subtract that, and I'm going to put it right here. So if you do the 40 million minus 800,000, we're going to subtract 39,200,000. And our amortized cost then is going to be the 240,000 million minus 39.2 million equals $200,800,000. So this is something that's going to appear on the balance sheet of Tanner UNF. So that's how it's going to look like. And let me just kind of highlight this and color code it so you can see. Oh, that's really bright. I'm going to make it a lighter color. Let's make it this color here. Okay, there. Doesn't hurt the eyes as much. So that's how that's going to look like in their balance sheet. Okay. So just keep in mind that if sale before maturity isn't an alternative, increases and decreases in the market value between the time the debt security is acquired and the date it matures to pre-arranged maturity values are relatively unimportant. So for this reason, if an investor has the positive intent and ability to hold the securities to maturity, investments in debt securities are classified as held to maturity and reported as amortized costs rather than fair value in the balance sheet. So this is exactly what we did here. It's reported at the amortized cost because the investor has the intent of holding these bonds until it matures. If it doesn't have the intent of holding the bonds until it matures, then we'll have to update that value of these bonds to the fair, the market value, and it'll change every so period when we prepare our financial statements. But that's kind of discussion for the, I think later on for some of the other investments, and I'll show you that in the other problems. Okay, so hopefully you get a better, and so hopefully now you have a better understanding of how this, the requirement 3 is asking for. Okay, so for requirement 4, requirement 4, there we go. Suppose Moody's bond rating agency downgraded the risk rating of the bonds, motivating Tanner UNF to sell the investments on January 2nd, 2014 for $190 million. Prepare the journal entry to record the sale. Okay, so in this case, they're saying that in a way, TNF is going to sell the bonds before it matures. How is this recorded? Okay. Well, first of all, think about this. For selling bonds, we know we're going to get cash in. So we know we're going to have to debit cash. And we can debit cash. We can call this proceeds from sale of bond. Okay, you can do that, or proceeds from sale. That's perfectly fine. Okay. We will also take the discount on the bonds off the book. And we will either have a loss or a gain. So a loss will be debited and a gain will be credited. So we'll leave a space here just in case it's a loss. And I will go ahead here, and we have to take the investment in bonds, the face amount, off the books. Because if we're selling something, we got to take that off the books, no longer needed in our balance sheet. So we bought the bonds for $240 million. We know that. So we're going to take that off the books here by crediting it. Okay. We know that we are selling the bonds for $190 million. So we're going to put that up here. Okay, and the discount on the bond investment, we already calculated here that that's what that is. Okay, because we calculate, if let's say this requirement was for a later date, later than January, this might change. Let's say we did in February, it will change, but because it's in January, right after December 31st, it will be the 339,200,000. So if we go ahead and, so from all of these amounts here, we can determine if we had sold the bonds for, I guess, if we had a gain or a loss, we can determine that from these three different amounts. If you add these up, all your debits, if they do not equal your credits, this, if you, in Excel, if you highlight over the numbers that you want to add up, down here in this area, hopefully you can see that, it gives you a sum of 229,200,000, which is short of the 240,000 million. So we know that we have a loss. And like I said earlier, if you have a loss, it's a debit. So it will be loss on sale of investment. And it will be then, I'm going to do a formula here, but you don't have to do a formula. You can do this on a calculator and put it in. Okay, and should have done it this way. Plus, there. It would be subtract. There we go. Okay. So our loss on this investment in the bonds is $10,800,000 because we decided to sell it on January 2nd for $190 million. If let's say we had sold it for more than $190 million, let's say we sold it for $230,000. Let's see how that looks like. Okay, in that case, we would have a gain. Okay, see how that is bigger there? But then if we had a gain, okay, because if you add these two together, it certainly is way bigger than the investment that you initially invested into the bonds. So what you can do is add these two together and subtract this, and we would have a gain, and that would be gain on sale of investment for that 29,200,000. That's only if we sold it for 230 million, but that's not the case. So I'm just going to undo everything. We sold it for 190 million, not that example scenario I made. So in this case, we had a loss on the sale of investment of $10,800,000. Okay, so that's for that one. Hopefully you get a better understanding of it. And once you go in and do the problem, you will surely get a better understanding of what's really going on. But this is just one example for 12-1. Okay, so this next one is going to be problem 12-1. And page 715. Okay. And once again, this is going to be the same concept. It's going to be on securities held to maturity investments. I'm going to show you again once the steps are similar to what we did in the previous exercises, 12-1 for brief exercise, and then exercise 12-1. And then in this one, it's just basically we're doing everything over, except we're not doing it. I have to write that too. All requirements except number 5. And this will be the same scenario when you do your homework. Number 5 will not be required. Okay. Okay, so requirement 1 we're going to prepare, and I do apologize, I forgot to read the problem. So let's read the problem first. Fuzzy Monkey Technologies, Inc. purchased the long-term investment $80 million of 8% bonds dated January 1st on January 1st, 2013. Management has the positive intent and ability to hold the bonds until maturity. For bonds of similar risk and maturity, the market yield was 10%. The price paid for the bonds was $66 million. Interest is received semi-annually on June 30th and December 31st. Due to changing market conditions, the fair value of the bonds at December 31st, 2013 was $70 million. So requirement 1, we are to prepare the journal entry to record Fuzzy Monkey's investments on January 1st, 2013. So same thing as what we've been doing before. So we're going to record the investment on the bonds at the face amount of $80 million. Let me just format my cell here. Okay. Once again, it was bought at a discount on bond investment, which is the difference. And then we're going to record the cash that we paid. All right. So we paid $66 million for the 80 million bonds. Our discount then is going to be the difference of that of $14 million. See? Okay, so that's what we do for requirement 1. Requirement 2, we are to record the entry for the interest on June 30th at the effective rate. Okay, so once again, we know that we're going to get cash in. So once again, these bonds yield 8%, but because we're calculating interest semi-annually, that's twice. So you take the 8 divided by 2 times the 80 million. Okay. We're going to record that discount on bond investment. And we're going to record the interest revenue. Interest revenue is 5% times the 66 million plus the 10%. I'm just going to do 10% as the, now let's do this. All right. Okay, looks like I'm jumping a little ahead here. This one isn't supposed to be here. I was looking a little bit ahead. So 5%, instead of that 5% times the 66 plus 10, it was supposed to be 5% times 66 million. Okay. So we do 66 million times 5%. We get 3.3 million. And our difference then is 100,000 for our discount on bonds. Okay, so the requirement 2 was, this was at June 30th, 2013. So for requirement 3, and this is a new step that we haven't done yet. We are required to Prepare the journal entry by Fuzzy Monkey to record interest on December 31st, 2013 at the effective rate. Okay, once again, we will be debiting cash for the 4% times the 80 million. Okay. We will debit the discount on bond investment, which is our difference. And then we will be crediting interest revenue with the 5% times the 66 million. And we must add in this 100 million of bond discount. 100,000. Okay. All right, so, and if you're wondering why we're doing that, I mean, on page 657, under the recognized investment revenue area, it shows you the reasons why we record interest revenue under this method, or do it this way. But because the discounts from a previous interest period is also considered an initial investment, that interest must be recorded along with that 66 million. So when we are recording interest revenue, we're going to take that 66 million plus the $100,000 in discount, and that's going to be considered also into the 5%. So basically, it'll be 66 million plus the 100,000 would be 66,100,000 times 0.05. $80 million times 0.04. Okay. Then my difference will be, oh, come on. The 105,000 will be the discount on the bonds investment, which is the difference. Okay. All right, so requirement 4 then. At what amount will Fuzzy Monkey report its investment on the in the December 31st, 2013 balance sheet, and why? So this is the same concept as what we did here, over here. And let's see, I'm going to just copy this. I'm going to paste it here, but I'm going to just say Fuzzy Monkey here. Okay. All right, so in the balance sheet area, you'll see investment on bonds, and that investment is listed at 80 million. We're going to subtract the discount on bonds, bond investment. Okay. Amortized cost then will be the difference. Okay. And let's just write it here. Let's do this. All right, so we have 14 million initially. We're going to subtract the 100,000 here. And we're going to subtract the 105,000 here. I'm not going to write these in here. I don't think I'm going to have room. I'll just do this. You know where I got the numbers from, so Okay, so I take 14 million minus 100,000 minus 105,000. I should get $13,795, and my amortized cost then is going to be the difference between the two of $66,205,000. So that's going to be my amortized cost, and this is how it's going to look like in your balance sheet or the balance sheet of Fuzzy Monkey. Once again, I'm going to go and just highlight it so you know that that's the amount that's going to be, or this is how it's going to look like in the balance sheet of Fuzzy Monkey's balance sheet. And then once again, like I had said before, here in this area, the increases and decrease in the fair value between at the time of when the debt is acquired and at the time of when the debt matures isn't really material or important to the security, mainly because the investor has the intent of holding that security until it matures. So that is the reason why we classify these as securities held to maturity. Okay, so basically that's problem 12-1, and hopefully after these demonstration problems for P12-1, E12-1, and brief exercise 12-1 makes a little more sense to you. I will post the notes here. I'll post the notes here along with the video so that you can have a chance to go ahead and print them out and use them for reference when you go ahead and do your practice problem or your assigned homework. So if you have any questions, feel free to email me.